Good morning, everyone, and thank you very much for joining me. This is the morning market review with myself, Russell Shaw, Senior Market Specialist at FXCM. Today is Thursday, it is the 20th of April, and my email address rshaw@fxcm.com. So if anybody needs to contact me, that's the email address to use. Let's just go ahead and bring up our disclaimers. I'm going to keep the high risk investment warning on screen for a few moments. And just while I have this on screen, can I just confirm that you guys can hear me, see the screen, and see me? Thank you, Shadrach. Okay, nice to have you on the webinar as always. Let's go ahead and bring up the market commentaries disclaimer, and just explaining that whatever we discuss in the webinar is not investment advice, it's a general market commentary. And our references MarketScope 2.0 and TradingView.com. And I want to start off by actually going to TradingView. We haven't looked at TradingView I don't think we've looked at it this week, or certainly not yesterday. I've got the US 2-year yield here, and what's coming back into markets in terms of a theme is interest rates. In other words, the interest rate cycle is now being rethought. In other words, are higher interest rates still with us? And the 2-year yield is reflecting that. It started moving up. Okay. The reason that there is rethinking of interest rates is because inflation is proving quite sticky. We saw that in the data out of the UK yesterday. We'll take a look at that data in a moment. And but the point is, take a look at the US dollar underneath that. The US dollar hasn't responded. So I'll just put sort of a question mark here. Okay. And let's throw in a correlation coefficient just to see how these are correlated, and the correlations are quite strong. So let's just bring that in. Okay, and we must just make this the US dollar, right? And you can see that is generally a strong correlation here. It's generally a strong correlation. It's broken down a little. In other words, the 2-year yields are moving up, but the dollar is staying flat. And so there may be a reaction. So I think two things can happen here. Either the US 2-year yield comes down and the correlation fixes itself up that way, or the US dollar gets pulled up and the correlation fixes itself that way. But it's a fairly robust correlation that tends to, whenever it loses itself, it kind of realigns fairly soon after that. So the idea here is that the US dollar not quite moving. Now, what we've been talking about this week, I'm going to come back to TradingView in a moment, but I just want to bring up MarketScope, because what we've been talking about this week is the fact that the US dollar has been stuck in this no man's land. It's been stuck in neutral in terms of our channels, right? It's between the blue Bollingers, which we call zone 2. It's effectively the neutral area. We're moving sideways. Take a look what's happening with the stochastic here. Stochastic is actually moving upwards. So the momentum seems to be building towards that upper quintile. So we've got to just watch the zones. Are we going to get pushed back into zone 1? Wouldn't that be interesting? So at the moment we stuck in zone 2, but there are pressures that seem to be suggesting dollar support. Now, let's come back to the dollar in a moment. I want to go back to TradingView. I want to just take a look at this in terms of the real yield as well. So what we'll do is we'll just go US 10-year minus the 10-year break even. Okay, so let's just bring that up. And let's see what kind of action we see on the charts. And again, the real yield is showing signs of liftoff here. The dollar hasn't followed it up yet. So take a look at the correlation. Again, a very sort of strong, robust correlation since April last year, and that was when the Fed really gave us more information about its quantitative tightening. And the idea here is, well, there's two ways for the correlation to potentially fix itself. Either the 2-year yield comes down or the US dollar moves up. And I think for the US 2-year yield to come down, we're going to need to see more weakness in economic data. So we're kind of at a crossroads here. Which way are we going to go? Are we going to see the dollar moving up? We're going to see the US 2-year or the real rate moving down. And we're going to have to watch that very carefully. Let's just go back to the market scope and talk about what's happened just over the last week. Governor Waller, the Federal Reserve governor, was quite hawkish last week, Friday. He said there hasn't been much progress on the inflation front, and that he's still quite hawkish. And what happened was the dollar really was breaking through its support at 12,750. It looked like it was going to be quite a sort of vigorous move to the downside. And then Waller came in with his comments, and that supported the US dollar. Also, we saw University of Michigan data come out on Friday, and whilst we haven't really discussed it as of late, they do have inflation expectations. Inflation expectations were higher. So again, that served to support the dollar. Now, we haven't seen any follow through this week. And I'm finding that's quite strange. Well, we've seen the bond market lift in terms of yield, okay? Seen the yields move, not really the dollar. But I think that we have to agree that if the yields don't give, then there's support for the greenback. So we want to watch the zones here very carefully. Let's just take a look and see what's happening on the weekly chart. And the weekly chart, I think, is very much in line with what's going on in the daily chart. Last week, we saw a doji. What's a doji? It's a candle of uncertainty, isn't it? Bulls try to take price up, bears try to take price down. Where do we end for the week? We end quite flat. What about this week? This week is an inside week. There's been no movement by the bulls to take the dollar above last week's high. There's been no movement by the bears to take the dollar below last week's low. So we kind of see this neutral price action. And so not much volatility this week. Not much volatility this week. So just to paraphrase what we're saying, higher yields supportive of greenback. If they're supportive of greenback, okay, and the greenback hasn't moved yet, are we still going to see that movement in the US dollar? And if we see that movement in the US dollar, what is the euro US dollar telling us? So let's go through to euro US dollar, do an analysis there with the thought forefront that yields are pushing up. Are the yields going to give, or is the dollar going to move up? It's that crossroads that we're talking about. So you can see that this 110 is proving to be a very strong resistance area. If we go down to the daily chart here, it's on the cusp of coming back into zone one. I think that we've got to watch this very carefully. If the dollar does respond to the higher yields, then euro probably going to be pulled down, isn't it? So we're going to have to watch it very carefully. What's happening to the stochastic here? The stochastic's starting to lose momentum. Okay, so there does seem to be elements of a risk-off environment starting to develop. We've got to be very careful here. We don't want to predict, but we want to take note of the warning coming out of the momentum, which seems to be starting to dip. Just want to check comments here. Bear with me a moment. Which chart are you referring to, Anna? Anna's just saying the tight bands will also break suddenly. Are you looking at the US dollar? Okay, cool. Let's just go back. Very good observation. Okay, what Anna's noticed is that there is a tightening of the Bollinger's. Okay, and what tends to happen when the Bollinger's tighten is that it sets up for the next burst of volatility. So that's a very, very good observation. In effect, we've got the dollar positioned in no man's land. The problem with Bollinger's, is that they don't really tell us much about which way the volatility is going to break. But the point is, the zone analysis will help us, and of course, the fact that we've got those higher yields and the higher stochastic. Just we need to be very cautious here. Cautious, okay. Chris just asking for the Bollinger settings. So Chris, the red bands are your standard 20 and 2. Okay, so 20 periods and standard deviations would be 2, and then the blue is a 20 period, but then the standard of deviations I've dropped to 0.75. Okay, so those are the settings there. Settings for the stochastic is 15.5, and then I've taken out the %D. Okay, so very tricky market in terms of currencies. Now, what we're going to do is we're going to go through to the stock market. We're going to go through to DAX. And again, I think that the caution that we're talking about here needs to be applied to stock market as well. And I'll tell you why in a moment. What do I want to do here? Let's take these out. It's funny how these studies carry from one chart to the next. You guys know, I've told you this before, I really like the DAX chart. It's got a really phenomenal looking primary trend. I really like the way that it's situated zone-wise. And I love the stochastic. It's just sort of surfing the upper quintile. And as long as it stays there, it's bullish. But the problem that we have is the prospect of higher interest rates. Higher interest rates do act as a headwind against the risk markets. So again, the theme of we're at the crossroads. Does the yields give? Does the dollar get pulled up? I think that's going to flow through to the risk markets. Let's take a look at NASDAQ. Let's just see where NASDAQ's positioned in terms of the bands. And NASDAQ's actually been moving sideways, and it remains in zone 2. So there is why it's instructive to look at NASDAQ, because NASDAQ is very sensitive to interest rates movements, just for the way that the growth companies interplay with the time value of money. You can see that we're in zone 2. We've dropped from zone 1, we've gone into zone 2. We've lost a lot of volatility here. It's starting to move sideways. I think an observation here, and perhaps a tightening of the bands as well. So there is certainly something that seems to be setting up in the markets, and we don't want to be caught on the wrong side of that. We want to be very, I'm going to say it again, cautious here. I'm going to bring up Trading View. Okay. What I want to cover in Trading View, I just want to take a look at some inflation charts. I think we'll look at those last. I want to go back to the Bollinger Bands. So what Anna's noticed, the squeeze. Let's take a look at that in terms of the Bollinger Width Indicator. I'll explain what that is in a moment. So let's bring the US dollar up here. I'm going to stick in some Bollingers for us. Chris, I'm going to show you the settings here. So let's just go Bollingers. I'm going to put in 2 Bollingers here, and just double click on that. So 20, make this one 0.75. I don't want the middle moving average, so take that out. And then with the second one, just double click, take out the moving average. I like making this red. And then I'm just going to leave it as the 22, right? So we've replicated the chart on MarketScope. We've replicated that into TradingView. Let's add in the Bollinger Width indicator, which I think is a really good indicator as well. I'll explain to you what that is. Bollinger Bands Width. Okay, wow. Okay, so what this indicator is, it's measuring the space between the red Bollingers. If I double click on it, you see I've still got the settings 20 and 2. So it's measuring the space, and as it starts squeezing, you can see that the Bollinger Width indicator drops. Look how narrow we are here. My goodness. So the dollar's setting up for something here. I'm very nervous with the interest rates elevating, very nervous. So you can see, and what tends to happen when we shoot above 0 on or 0.1 here, that tends to be the breakout. So let's watch for the breakout, and let's see if it hits towards zone 1 or zone 2. Very interesting. Let's just take a look at NASDAQ as well here. All right, and you can see the volatility here has dropped off to the point that something's going to happen. All right, something's going to happen. Now, let's just take a look at inflation, core inflation, and this is something you and I are going to have to watch very carefully. So the first inflation we'll take a look at is United States core. Let's take that out. I want to take out the Bollingers here. I want to look at this in terms of acceleration, deceleration. And what's happened is that the core ticked up. Let's just add a rate of change to the core inflation rate here. And why are we looking at inflation? Is because inflation is going to drive interest rate policy. Interest rate policy is going to drive the markets. So let's just bring up the rate of change here. We'll take a look at three core inflation. We'll look at core inflation from 3 regions. The first one is the United States. We have to maintain a deceleration here. If we maintain the deceleration here, we're okay, and we should see the core inflation coming down. Okay. Gertie yesterday emailed me. He wanted the codes for the core inflation out of the UK. Let's just bring that up. and do the same same analysis. This was really a good email to receive. Thank you for that, because it really does highlight. So if we take a look at the United Kingdom's core inflation rate, we're not below zero. We're positive. We're at 8.77. There's still a slight acceleration on. We're heading towards zero, so we're heading to kind of a flat line, but that's no good. Okay, zero is no good. We have to get below zero. We have to see a deceleration. That deceleration is what's going to prompt disinflation, and we want the disinflation to get back to target, which is around about 2% for central banks. So you can see that this area here is what we're looking for. I think that the Bank of England has to go with an interest rate hike, because they need to get the rate of change of United Kingdom core inflation. They need to get it below zero. So the inflation story in the UK, certainly not as controlled as it is in the US, but what I wonder is if it is global in nature, and if because we already saw that core inflation tick up slightly in the US data, we need to see these rate of changes get below zero. It's very important. The last region we're going to look at, Euro area core inflation. So let's take a look there. Okay, and you can see that Euro area core inflation, to me, still has a lot of work to be done. And it's a no wonder that the ECB is so hawkish. Okay, there are market commentators out there calling for one more hike and then they're done. That's not going to be possible until we see the deceleration. So I think the scenarios are as follows. The interest rate hikes need to still come through the transmission mechanism. And if we haven't seen the effect of the transmission of the foot effects coming through the transmission mechanism, then we can still see progress. Otherwise, we're going to see higher rates, and all of that's starting to be reflected in the yields. So we want to see this inflation data come more under control. It's very important. Okay, must come more under control. It's not quite where we need it to be, and that theme is now coming back into the markets, starting to rattle the markets. One last chart, and then we'll end. One last chart. So we're going to take a look at the VIX. So what the VIX is called the fear index, and it effectively takes a look at options on the S&P 500. And options are often used as sort of an insurance policy for when there is negative sentiment. It's usually looked at as a contrarian indicator. And let's just add in an RSI here. So we're going to add in an RSI. I want to add a Bollinger onto the RSI. We'll take a look at this on the weekly basis. Okay. And what I'm going to do here, I'm just right-clicking on the RSI. I'm going to say Add Indicator. I'm going to add a Bollinger Band. Now, just take note of the settings for this Bollinger Band. The settings I like to apply is a 50 and a 1.5. That tends to work for me. There's no hard and fast rules there. I just want to bring in one more chart underneath that, the S&P 500 underneath that, and let's just see if we can see any ominous signals here. I'll just make this logarithmic. Okay, just want to go into, so just take a look at these areas here. All right, so we're not quite into sort of the danger zone here. So I'm just looking to see if the RSI of the VIX breaks below the lower Bollinger. When it does that, it seems to suggest we are near intermediate market tops. See that? In other words, the complacency gets it. We're not quite there yet. So let's carry on looking at the VIX over the next few weeks, just to see if there is a complacency that emerges. Tesla earnings came out. They've been cost cutting crazily, and they're going to continue to cost cut, and it's putting pressure on their margins. So margin pressure, well, that could put pressure on the stock markets. All right, guys, that's as far as we're going to go today. If there's any questions, please go ahead and type those in. We covered quite a bit this morning. I hope that you guys found it useful. Any questions? All right, let us wrap up here, guys. Thanks, Anna. Have a good day ahead, guys. Have a good evening ahead. Chat with you guys tomorrow morning. Thanks very much.